Ultimately, these patients have very few options for treatment. They were dosed with a gene therapy, and we showed a 75% reduction in the effect of that damaged gene to those patients over time. So you're seeing something for the first time that is truly unique and absolutely game-changing for patients in this space. You're seeing an actual effect to the disease happening.
So how does somebody that does what you do look at a chart like that?
Yeah.
And I'm assuming that let's put it back up, guys, please. From the winter, it's in trial, and that's why it's a straight line across.
Yeah.
And then there's a result that results in a move like that. Are you still staying in the stock?
I am.
You are. Why?
I am. So ultimately, it is a platform technology, what they are doing in Huntington's disease, and the total demand that will be there once this ultimate application is approved has tremendous potential, multi-billion dollars just in Huntington's disease alone. When you look at the valuation of the company, of the potential of what this could mean globally for these patients, it is still actually very attractive to be owning a Unicure at this point. And I think to your point on how do you time these, there's a cadence involved in investing in biotech, which a lot of sectors don't have. And it's the additional, component of looking at the space of timing when and how you think there's going to be a dramatic move or shift in the stock price.
But you're not just playing, I guess part of my question was, you're not just playing for the event itself, right? You're playing for the post-event.
Absolutely.
Which you could actually get. That's why if you would have said, well, we're selling because the stock sort of paid off how I thought it would. The fact that you're not is as telling as the other way.
You bring up a great point. It is something that is dramatically returned to biotech over the last couple of months. You can purchase these stocks after the event has played out and see tremendous return potential. Unicure was one of those names. You could have bought it that morning on the open or pre-market early days and still had ultimately 50, 60% return from having that full data set, having heard the company discuss it. There are a multitude of ways to make money in biotech, and that's been a fairly new incorporation of a way to really do some great outperformance in the space.
What about Abivax, which is up 1,000% year to date? Presumably they had their own event.
They did, and actually just released a little bit more data today on that. They have a new product, phase 3 data in an ulcerative colitis drug. First new technology of its kind. It works in the most severe patient population, those who we call are refractory to other therapies. It is a game changer potentially in the space. We think it will work not just in ulcerative colitis, but in other areas of autoimmune GI. So you can look at potentially Crohn's disease and others and see this as something that will expand over time. This is another great example of a name you could buy or could have bought that morning on the first data set in the 50s. It's close to $100 now. So there's this unique dichotomy of being able to see a compounding of your investment after that data card has turned.
Okay, let's go one more to a stock that's lagged year to date. It's done well lately. It's Scholar Rock.
Yes.
SRRK.
One of my favorites.
What do they do?
Scholar Rock has also a late-stage drug. They have shown their data set. We are waiting FDA approval in an indication called spinal muscular atrophy. It is a rare disease. It is a neuromuscular rare disease, an indication. A number of children and adults are afflicted with it. This is also a major modification to the way these patients are going to be treated, and we think that this has tremendous potential in terms of sales and growth rate over time.
Really interesting conversation. I enjoyed it. Michelle, thanks.
Very good to see you.
Michelle Ross joining us once again on Closing Bell. Still ahead, a rundown of what to watch for from Constellation and OT. But first, Morgan Stanley's Sherry Paul. She maps out her market playbook for you. The Bell's coming right back. Up next, Morgan Stanley's Sherry Paul tells us how she's advising her clients at these all-time highs in stocks. She joins us after the break. We are back. Stocks, gold, and Bitcoin all looking to extend their record closes today. So where is the best place to be positioned if the market is, in fact, going to have an end-of-year melt-up? Let's ask Sherry Paul. She's Private Wealth Advisor and Senior Portfolio Managing Director at Morgan Stanley. Welcome back.
Thank you.
So how do you feel about this market at a time where I think it's almost daily we're having a conversation about AI bubbles or not? And you're having some of the most successful investors in the world weigh in on that topic. Yeah. What do you think?
Well, look, I mean, we've had 30 new all-time highs,
plus,
this year alone, plus.
More.
Yeah, I think actually now we're at 31 maybe today. And, where do we start about all the good things that are coming, in terms of the investing climate? We've got $5 trillion sitting in cash. We've got pretty low unemployment. We've got earnings revisions, moving upward. We've got a tax bill kicking in January for corporate tax cuts. And deregulation, M&A activity kind of heating up. And so, you put all of that in the context of AI innovation and as an accelerant to all things, then there's still room to move here. And just because markets are going higher doesn't mean they're not going to continue to do so.
Wow, I mean, you sound like you're talking about like a super melt-up. I mean, Paul Tudor Jones was basically saying that too. He just said it's going to end badly.
Well, look, I mean, I think that there's some people talking that way, but I mean, I've been watching the playoff games, and you don't know how many runs you're going to hit in the last inning. I mean, it could be, a monster last two innings here. So I think it's hard to say that, and it's hard for people to hear that because they're waiting for the shoe to drop. But we just don't have those conditions for the shoe to drop.
No, not yet. I mean, but so if we agree with you as an investor class, we say, you know what, I totally agree. I mean, it may end up badly at some point, but not for the next however long. So I'm going to play the cards I have in my hand. What does that mean for where I want to be?
Well, for individual investors, and remember, like, I work with people that live in their money, and so they're always wanting to know, like, what do I do now? And so for investors that have really benefited from this market over the last few years, we're taking money off the table and we're funding life goals like college plans and wedding accounts, and taking tax deductions and donor advised funds, and taking gains in a way that can materially benefit that overall life money plan. And for new clients that we're onboarding that have missed the market for whatever reason, because indecision is a killer of returns, and so is inflation, we're building portfolios that are well allocated across what I call the idea maturity time horizon, because we're also not only are we at all-time highs, but we have all-time correlations happening in the market. And so this principle, the mathematics of diversification, also stretch. And I think that's where your bubble folks get a little bit hung up, is on PEs and correlation, and they're missing the moment on, like, wow, we have an idea here that is going to accelerate and consolidate very rapidly over the next few years. You don't want investors to miss that.
No, but you have to be cognizant of what you think is already in the prices of some of these stocks, and they've already gone up so much. The numbers are so large, both in returns and in investment from these companies. It needs to pay off.
Well, you heard that 2 years ago in 2022 when people were looking at the PE ratios of a lot of what now we're calling the AI innovator stocks and going, wow, these are stratospheric type PEs. And what happened was the earnings came through and we saw the PEs go down. And so for even you don't want to get too myopically focused on PE ratios in these radical moments of innovation, because the trend could be a J curve at the end, this explosive sort of setup. And that doesn't mean that everything you should have should be in AI, or that you've got to get every last penny off the table in terms of your returns, which is why I also suggest that, that right now in a fast market, like, your best friend is rebalancing. I mean, you should have a strategy that has bandwidths, that has an allocation, that you're taking money off the table, reladdering it into a portfolio in a way that you're not too over your skis in any one moment.
You like what's largely worked, tech, industrials, and financials. We spent many months talking about record highs in all of those areas. So you want to stay large in market cap?
Yeah, large balance sheets. Balance sheets give you dynamitism, and that is, I think, and liquidity. It's one of the most crucial ingredients to be able to capitalize on radicalized moments of change, which is what we're in right now, and that's why I like the big caps.
All right, we'll leave it there. Sherry, thanks.
You're welcome.
Sherry Paul, Morgan Stanley. Up next, we track the biggest movers into the close today. Christina Partsinevelos standing by with that. Hi there.
Hi. Well, we have a rare earths miner surging on government talks. A major retailer gets hit with a downgrade, and an EV maker, guess who, drops a cryptic hint. We've got those stock movers next.
Sector Sort is sponsored by Sector Spider ETFs. Sector Spider ETFs. Visit us on the web at sectorspiders.com.
We're less than 15 from the bell. Let's get back now to Christina Partsinevelos for a look at the key stocks that she's watching. Top of your list?
I've got a lot.
What?
Let's start with critical metals. Those shares are soaring after Reuters reported the Trump administration was in talks to take an equity stake in the miner. The company is developing a rare earths project in Greenland. However, a senior administration official told Reuters there's nothing close with the company at this time. Shares are still up, look at that, 47%. Abercrombie & Fitch sinking today after JP Morgan downgraded the retailer to neutral from overweight, the firm citing a hangover effect related to outsized promotional activity in the first half of the year, and that's why JP Morgan slashed their price target to $103 from $145, sending shares almost 8% lower. And then you got, did you guess it, Tesla? That was the name of the company, the EV one. Shares popping after the company posted a teaser video on X yesterday. The video ends with the date 10.7, indicating an announcement tomorrow. That would be October 7th. Speculation is that the EV maker is gearing up to release a new car, and that's why you're seeing shares up almost 5%. And last but not least, this is new. Shares of AppLovin falling right now as we head into the close after Bloomberg reported that the company has been probed by the SEC over data collection practices. Shares are plunging now 17%, Scott, and this news just came out.
Story. Yeah, thank you for that, Christina Partsinevelos. Coming up next, what to watch for when Constellation Brands reports in overtime. Plus, JP Morgan Asset Management's Mira Pandit. She is standing by at post 9 with her own market playbook. We'll do that in the zone next. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli and JP Morgan Asset Management's Mira Pandit are here to break down these crucial moments of the trading day. Plus, Kate Rogers tracking the action in food stocks today, and Brandon Gomez standing by with what to watch for from Constellation Brands in OT. Mike, begin with you first. What do you make of the action today?
Shows both the power and the limits of yet another massive AI infrastructure announcement. Obviously, AMD's adding more market cap than NVIDIA is detracting, but it's a relatively mixed and uneven performance. I think it mostly tells you where the field position is. already priced in a lot. The index has definitely been churning to new highs successively. It's very much a growth over value, kind of high volatility over stable volatility type stocks, and frankly, low quality over high quality. So that's the phase of the rally we're in. I don't think it means that there's some kind of monumental comeuppance on the way, but it does tell you maybe the threshold for really pleasing this market in the same way has gone up.
All right. Kay Rogers, what's happening in food stocks today?
Hey, Scott. So Bank of America out with a note this morning on the restaurant sector saying that macro pressures are broadening across the space and noting that younger workers in particular are feeling the pressure, writing, quote, unemployment is higher for recent college grads than for workers overall, a dynamic that contrasts with pre-COVID trends and one that appears to be accelerating. Now, analysts say that full service concepts are actually more insulated because they have higher incomes and their consumers are older. Take a look at shares of McDonald's, Yum, they're up on the year. Wendy's and Shake Shack, though, lower significantly year to date. As for the casual and full service names, Darden slightly higher, while Bloomin' Brands and Texas Roadhouse are lower. And finally, the pizza names just slightly higher on the year. The OFA downgrading Sweetgreens, Papa John's to neutral, Shake Shack to underperform, and upgrading Brinker to a buy. Back over to you.
Kate Rogers, thank you very much. To Brandon Gomez now, what to look for from Constellation and OT. Tell us.
Hey, Scott. Yeah, the Corona and Modelo Brewer reporting after the bell. Wall Street bracing for a soft quarter. Consensus points to $3.38 a share in EPS, down 28% year over year. Revenue roughly $2.5 billion, but beer remains the backbone here. Expected to see net sales of $2.3 billion, while wine and spirits remain under heavy pressure with projected declines. Now, remember, the company cut guidance just last month, so some of this may already be priced into shares, down around 14% since then. The conference call is tomorrow morning at 8 a.m. Eastern, but investors will no doubt be listening for any updates on raw material costs, continued tariff impacts, softer consumer demand, especially among core Hispanic consumers, which the company previously has said accounts for about half of its beer sales. Scott.
All right, Brandon, we'll see what happens. Thanks very much. Brandon Gomez said Mira Pandit joining Mike Santoli here for the conversation. It's good to have you back. Record closes on track for the NASDAQ and the S&P. Mike said growth over value. Is this the way it's going to be for a bit?
Don't fight the Fed, don't fight fiscal, don't fight AI. When you have this trinity of catalysts for the market for the next couple of months, it's really hard to want to back off at these levels, even though valuations are pretty much as high as they've been in many years, if not since the coming out of the pandemic, also since the early 2000s. But I think the reality is when we think about AI and we think about some of these big announcements, as long as companies are maintaining revenues or growing them, as long as that cash position from a funding source for a lot of these investments is still intact, then that is a good sign of the health here. But I do pay attention to some of these circular announcements where it sounds like there is a lot of, again, that circular economy here between some of these big tech names. So we want to make sure the way that we're assessing these companies stays true to form, and we don't start sliding into announcements of future deals that may or may not happen.
Sure, but I think the prevailing thought from most people who've been coming on the network, even those who are concerned about some issues like you are, is like the music's going to play, and you have to be on the dance floor while the music's playing, because you can play for a long time before there's a record scratch.
Well, this DJ has a lot of different genres it's playing right now, and that's the good news. It's been so concentrated in AI over the past couple of years, but this year, if you look at what we've seen so far, if you look at the best 50 performing stocks so far year to date, 9 out of 11 different S&P 500 sectors are represented. Only one Mag 7 cracks that list. And so we're certainly seeing that broadening out of AI into areas like industrials and utilities, but we're also seeing beyond that other names doing well. And it's not just a one-trick pony anymore where it's just about the U.S. and there is no alternative. There are alternatives overseas. There are alternatives when you think about the capital structure and the credit markets of some of these same companies to take advantage of those profits. So there are some options out there for investors.
All right, so this is the house music stage of the rally. We'll figure out what's next. To Mira's point, outside the U.S., there are a couple of interesting calls today. Upgrades to global equities, upgrades to emerging markets, U.S. stock market trailing the rest of the world by the largest margin in a long time.
I mean, the Japan market overnight was up several percent. And I think what's interesting is if you try to read it for what signal it might be sending, I mean, right or not, the global markets are suggesting there's this kind of reflationary, accelerationary theme going on in markets. Copper running. Emerging markets is really kind of quasi-AI story as well. I mean, Korea is 1/3. Samsung and SK Hynix, it's in the EM. China obviously been running there too. But more to the point, I mean, Mira mentions fiscal. Everywhere you're seeing fiscal expansion. And so you can tell a story of this bull market as massive amounts of capital, $1 trillion plus unleashed from Mag 7 balance sheets to invest in AI infrastructure, and a similar amount released by global governments, whether it's Germany with €500 billion for military or it's Japan expected to do the same. So how far that goes, how long that lasts, whether equities are the way to actually, harness that are all good questions. But I do think it's interesting that we're in this moment where it's really hard to pull the investors off of the idea. The Fed is leaning lower into what might be the makings of a reflationary trend.
Yeah, like everybody's cutting rates. So the first central bank to hike versus the first hyperscaler to cut their spending outlook. We'll weigh which is going to be the end of this whole party. I don't know. How are you thinking about that, though? Some of the risks that do stand out there to say, okay, maybe it's time to take a breather.
When I think about the economy overall, I would say when we think about growth in particular, you can sometimes see that from an inflation standpoint. If you think about tariffs folding in here, sometimes that can be a bit of a transitory factor, whereas labor market weakness rarely is. So weighing how long that growth is boosted and supported into next year relative to when it starts to fade out, and if inflation does properly fade out or not. And we're in this tug of war here between inflation being hotter and the labor market being weaker. So these are some of the risks to the economy that can then permeate company earnings and company spending patterns as well.
I think also the market is implicitly making a pretty big bet on the idea that very soft labor conditions are not reflective of the broader economic fundamentals. And the weak housing market is not going to really hamper, the kinds of macro fundamentals that feed into S&P earnings. That's implicitly the way the market is playing this, and we'll see if that has to get tested along the way.
Well, that's why some are talking about the possibility of an everything rally, right? Because you not have these deep economic fears based on certain things like what's happening in housing. So it's gold up, Bitcoin up, stocks up, emerging markets and international stocks up, and maybe not just the hyperscalers and the AI trade up, but do you feel like there's going to be a big broadening melt up into the end of the year?
Just because it's an everything rally doesn't mean we need to own everything. I would be careful around some of the areas that are melting up, some of the low profit areas, some of the areas that really don't have a lot of legs to stand on. So we do want to be mindful of where we're putting money to work. Just because it rallies doesn't mean you want to rally behind it.
And one interesting thing is the dollar is up today, and that has not typically gone along with everything else going up. Watch that. The conscious rate. So the bell's going to ring in a new record close for the S&P 500 and for the NASDAQ as well. Do it for us in the OC with John Ford.
That bell marks the end of regulation. Zeta Global ringing the closing bell at the New York Stock Exchange. Cerebral Palsy Foundation doing the honors at the NASDAQ. It's another mostly positive day for the markets. The Dow's down slightly, but gains for the broader averages. The S&P 500, NASDAQ, and Russell all closing at record highs. And enthusiasm over AMD, a big driver. The stock is up 23% after it's packed with OpenAI. Much more on that deal and its impact coming up. And it helped boost all of tech today, one of the best sectors, along with consumer discretionary. Consumer staples, one of the worst groups. Healthcare also pulling back after a strong week. Treasury yields continuing to rise as the government shutdown drags on. It is day 6, and there doesn't seem to be much progress on negotiations. Well, that's a scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Ford. Morgan Brennan is off today, and we've got all-time highs just about everywhere you look, including Bitcoin, where, again, the question is, are we getting too frothy? Mike Santoli is going to take a look at some speculative areas of the market. Gold, on the other hand, hitting a record 2. It's 42nd this year, near $4,000 an ounce. We're going to talk to Tim Seymour about the run for precious metals. And is AppLovin a sign things have gotten too hot? The company's got a market cap in the neighborhood of Goldman Sachs and Caterpillar, even with last hour's big drop. We're going to ask an analyst whether the love in with AppLovin can continue or if this drop is a harbinger of things to come. But let's start with this huge deal between OpenAI and AMD, which is sending AMD soaring in the neighborhood above 20%. Christina Partsinevelos is looking at that side of the story. Christina.
Yeah, 23% gain. It was actually its best day since 2016, top performer in the S&P 500 by a wide margin today. Like you said, after OpenAI just agreed to buy 6 gigawatts worth of AMD chips, resulting in potential tens of billions in new revenue for AMD. But the fact that OpenAI will use the chips for inference computing was really seen as a vote of confidence in AMD's AI capabilities and added to that boost you saw today. The ripple effects were immediate. Sanmina, AMD's data center infrastructure manufacturer, that closed up about almost 23%. Taiwan Semi, who makes AMD chips, rose about 3.5%. A software connectivity firm, Astera Labs, jumped 10%. High-speed connectivity firm, Credo Tech, closed 1.5%. And I should say the list just continues. But NVIDIA and Broadcom's muted reaction really tells you everything. This isn't a zero-sum game. OpenAI is hedging across every possible supplier with a multi-pronged silicon strategy. They've got a $100 billion deal with NVIDIA, a $10 billion order with Broadcom for custom chips, tens of billions with AMD, and they're even testing Google's TPU chips. NVIDIA, though, still dominates model training, controls the software ecosystem with CUDA, and holds over 80% of the AI chip market. So I guess you could see on your screen, 1% drop on this news. The market is saying NVIDIA's moat still remains intact for now. John?
Yeah, and as you mentioned, Broad Impact Supermicro up 5% today on that news, and Dell up 3.5% as well. Christina, thanks. Yeah. For the OpenAI perspective here, let's get to Mackenzie Sigalos in San Francisco at the company OpenAI's Developer Day event. Mac, this deal's a little unusual because it gives OpenAI the chance to invest in AMD just a couple weeks after NVIDIA inked a deal that could end up with it investing in OpenAI's infrastructure build-out, right?
That's exactly right, Sean. This is the opposite of what we saw with NVIDIA. There was NVIDIA investing in OpenAI, but in this deal, OpenAI is the one taking what could amount to a 10% equity stake in AMD, and it is part of this broader shift toward performance-based equity as a new way to structure these mega chip deals where ownership and infrastructure are increasingly tied together. Now, the deal also highlights a growing circularity in how AI is being financed. NVIDIA gives capital to OpenAI. OpenAI uses that cash to buy NVIDIA chips. And it's the same with AMD in a sense, only this time OpenAI is getting equity virtually for free and could eventually cash it out to then pay for the very chips that AMD supplies. It is a closed loop of capital, compute, and equity, with OpenAI at the center orchestrating the flow. And it's also about building a moat, not just against startup rivals like Anthropic, but against the hyperscalers. Google has Gemini, Meta has Llama. OpenAI is trying to own more of the stack, in part by getting into the business of building its own chips and data centers. John?
Mac, in a way, this is less circular, though, isn't it? Because a couple weeks ago, after that NVIDIA OpenAI announcement, some people were saying, oh, well, this is just NVIDIA giving money to OpenAI that OpenAI is going to use to go around and buy NVIDIA chips. But now OpenAI is committing to including AMD chips in its build-out. So it's not going just back to NVIDIA. It's actually going to OpenAI. And now OpenAI has this incentive, it seems, from the structure to see AMD succeed, no?
Well, this is additive to the deal that they announced with NVIDIA. You broke that news on our air that they would do this. Apps that it can't unveil now. Greg Brockman, the OpenAI president, said on our air that they have updates to ChatGPT. They have new products in the pipeline that they simply don't have enough compute to bring online. And that's the real ambition here. And we always knew that there wasn't going to be this exclusive relationship with NVIDIA. Sarah Fryer, the CFO, making it clear that they wanted to hedge their bets, in part to give them leverage when they go to negotiate with other chip makers.
Right, yeah, I'm just saying it's not circular. If it's branching out, right, and going to AMD as well, it could be that that OpenAI is acting as this sort of arbiter or driver within the ecosystem.
Yes, but they are the single point of failure for some of these deals, and that's what's concerning. The fact that they are, committing to spend $300 billion with Oracle. They've got this relationship with NVIDIA to the tune of $100 billion, and the concern is that if they are the linchpin of this new AI ecosystem, which is part of why they're trying to monetize, and that's what Dev Day is about. It's about finding ways to make money on apps. They are creating an app store. It's actually their third attempt at doing this, but bringing developers, the products from these developers in-house, trying to take a cut of that. We've already started to see that with integrations with soon-to-be Shopify, Etsy. They get affiliate fees, and that's the name of the game. Altman said last week, yes, OpenAI is catching some flack for Sora and the kind of content that it's producing, but he said this is a key part of our monetization strategy.
Right. The demand's got to stay and grow, and I guess everybody wants to see that, at least everybody in this ecosystem. Mackenzie, thank you. Let's stick with this story. Check out the pop in shares of HubSpot, Salesforce, Figma, Coursera, all mentioned on stage at OpenAI's Dev Day as partners. So what does all that mean for investors when one private company has so much sway over public stocks? Joining me now is Alex Kantrowitz, big technology founder and CNBC contributor. Alex, very seldom is so much of the demand in a global innovation push focused through one company in OpenAI.
Right. There's definitely a concentration risk here with OpenAI, and also a risk because so much of the stock market, so many of the companies that you just named are betting not on today's technology, but on tomorrow's technology, the technology that OpenAI keeps promising will get better and better and will deliver innovations we can't even think of today. And I think there is a real risk, given that that is the single point of failure, if it's unable to deliver those amazing results that Sam Altman seems to promise every other day, that there could be a cascading effect here where lots of companies could end up getting hurt.
There certainly is that risk, and we've talked about it here on Overtime, similar to the internet when we went through that trough of disillusionment where Amazon stock was trading way down and we had all that dark fiber from the telcos that Google ended up picking up. But I guess on the flip side of that, there's the idea that all the time when there's a huge shift, there's a risk about how long it takes for the benefit to get delivered. How does an investor, you think, calculate how much exposure they have to that trough of disillusionment opening up at any given moment?
Right. So this is what makes this moment so interesting and unique and tough to play as an investor. You already see, unlike maybe some of the early days in the dot-com era, you already see results from OpenAI. So you're really just doing a valuation game here, because the question is, how much is the market pricing in what's coming next, as I mentioned? I think this is the problem that I see in the market today. The market is priced as if you continue to scale data centers, you're going to get technology, AI technology, that's not just incrementally better, but exponentially better than what you have today. I mean, you look at what Sam Altman is writing in his blog, saying if we just had X amount of compute, we might be able to cure cancer. And that would give me pause as an investor, because ultimately that ideology is not really synced up with what we see in AI research today. If you speak with most AI researchers today, they would say that making the large language models that underlie the GPT models and the ChatGPT application, making them bigger isn't making them that much better. So if you're an investor, you just have to play with these ideas of I'm seeing something real today, but the valuations based off the expectations are probably out of whack.
I love a good debate, though, so I'm going to continue to take the other side. Right now, we're seeing a technology environment driven in part by the cloud, where unlike in previous eras, say the dot-com era, you've got these mega cap tech companies that are actually like utilities for compute and by extension for AI. And if this gamble works and AI does deliver at least most of what's promised, a lot of the benefit could accrue to these larger players, including not just NVIDIA, but Microsoft, Google, Amazon, Oracle, et cetera, and perhaps on down to OpenAI itself.
Oh, look, I'm totally with you. If we end up seeing most of what's promised, we're going to have an unbelievable future because a lot has been promised. But I was speaking with Thomas Kurian, the CEO of Google Cloud, earlier today, and I asked him about these investments. And I think he said something really important to me. He said, if you're generating wealth, then you're going to be in good shape. But if you're just moving money around, then we know how that ends. I think ultimately what this comes down to, and you're right to highlight it, is the bottom line. if these companies are able to generate a return on investment for businesses, which to date has been somewhat elusive, if they're able to run their chatbots profitably, which to date has been elusive, then they're going to make a whole heap of money, and we're going to see a lot of this pay off. And this is, again, it goes to the problem. It's an if, and there are a lot of ifs right now. And so nobody who uses this technology says it's a zero, but a lot of us are asking, what is the right number? And I think that's a very appropriate question to be asking.
Yeah, and that's why investors invest. Alex Kantrowitz, thank you. Bets on the future. Well, we're going to have much more on the future of AI tomorrow when Dell Chairman, CEO, and founder Michael Dell joins me in a first on CNBC interview on the back of their Analyst Day. You can see that right here on Overtime. And Constellation Brands, meanwhile, their earnings are out. Brandon Gomez has the numbers. Brandon.
Hey, John. Yeah, the street was expecting a softer quarter, but in fact, we got a beat on the top and bottom line. EPS coming in ahead of expectations, $3.63 a share ahead of the $3.38 that was expected. Revenues also coming in as a beat, $2.48 billion versus what was expected. In the release, they go through as well their Q2 beer revenue, also a beat, obviously a large part of the business there at Constellation Brands. Now, the company did cut guidance back in September, so perhaps some of the pullback already priced into shares, although as you see, shares now recovering. The company does say operating margins for beer did decrease largely because of unfavorable impact from increased cost of goods, things like cost absorption, lower volumes, aluminum tariffs, which we've obviously been hitting. We won't get any executive commentary until tomorrow morning on the earnings call, but we'll be sure to wrap headlines then as well. John?
All right, that stock up at the moment about 1.5%. Thank you, Brandon. Well, all-time highs, big tech deals, IPOs. This market is starting to remind a lot of people of the dot-com boom. Up next, we'll tell you the latest big name that's drawing comparisons to 1999. And we'll ask a panel how worried we should be. We'll be back in 2.
Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
That was Tudor Investment Corporation founder and CIO Paul Tudor Jones this morning on Squawk Box, saying today's market feels similar to just before the dot-com bubble burst, encouraging investors to position like it's 1999. Is he right? Well, joining us now is Citi Research Director of U.S. Equity Strategy, Drew Pettit, and Truist Wealth Chief Investment Officer, Keith Lerner. Keith, it's easier to say position yourself like it's October 1999 than it is, I think, to position yourself like it, even knowing what we know now, short of getting out of the market and then getting back in at some time later, market timing, which is unwise. How would you position yourself like it's October 1999?
Yeah, well, great to be with you. You know, the way we're thinking about things, John, is we've been overweight tech and communications most of this year. We're still overweight those areas. And maybe there are some similarities to the late 90s, but there's also some differences and some quantifiable differences. The first thing is that the technology sector as a whole, it is trading at a risk valuation around 30 times, but that compares to about 50 times back in the late 90s. Heading into the peak of March of 2000, the market was up, as kind of mentioned, on a year-over-year basis over 100%. On a year-over-year basis right now, the technology sector is up about 28%. And the other thing that's somewhat different in our view, and at least in our work, is that the earnings momentum today is a lot stronger than what we saw back then. So we put that all together. Yes, that's risk, but is it the same period as the 90s? Maybe the infrastructure build and all the spending that we've been talking about is moving that way. But from a quantitative, fundamental, and technical view, we're just not there yet. And we still think this bull market has longer to go.
Drew, let me try this with you. Even if it's not exactly the same, if perhaps we are in a sort of a bubble, how would you learn from October of 99 and position yourself right now?
Pair your beta. That's what we're saying to clients right now. So yes, the NASDAQ, to Keith's point, has really good earnings momentum, and we like that story. We believe in that secular story, and our team doing work on AI is just raising its infrastructure investment estimates. So we believe that story. But to your point, what do? Pair my beta with some cyclical beta. We're not chasing low beta, low volatility stocks right now in defensives. Instead, we'd rather add some small caps here, some cyclicals where we might have inflections, where the embedded earning expectations are really low. What a lot of people might not remember, the next growth area out of the market after the tech bubble popped was, well, financials and cyclicals. And guess what we're pairing a tech overweight with? Financials right now, in financials and small cap.
Keith, what do you think of that approach?
Yeah, we actually did upgrade our review of small caps back in August. Now, they've been cheap and underloved for some time. The difference more recently is earnings are moving up. And there is certainly concentration risk. And if you have a little bit of money that moves out of these large cap names, a little bit of outflow and inflows into small caps can go a long way. So I like the idea of at least hedging some of your risk with small caps. And also, if you think more globally, we're more neutral international. But look today, I mean, Japan's making more than a 40-year high. The EFI, or the developed international markets, are breaking out to a new high. Emerging markets are working. So as much as we're focused on the U.S. and the strength here, we are actually seeing global participation. So we would have exposure beyond just tech, but within a portfolio, we still have a bias towards tech and growth because we still think this is an AI-dominant bull market. And we think that trend ultimately continues, even if there's some hiccups along the way.
Speaking of AI dominance, Drew, what do you think of this latest news today out of AMD and OpenAI? There's been talk about circular spending, but to me, this looks like a branch off of it. It's not, OpenAI to NVIDIA, NVIDIA to OpenAI. This is going to AMD, no?
Yeah, we've been seeing this in tech. This is why we like semiconductors in tech, right? When you get in these cyclical investment periods, and I know we're talking about AI as a secular story, but the ground floor is what we have to focus on right now, and that's building the infrastructure, and semis are part of that, and we're happy that's broadening, and we're happy to see that within semis, part of our bull case there. The other thing, too, just going back to Keith's point, AI is a global story. We forget about that as we talk about some of the big names and private companies in the U.S., but AI at a reasonable price, ex-US, is one of our favorite baskets right now. And that has surprisingly outperformed all the US AI names off of the April lows.
All right. Drew, Keith, thanks to you both. Well, coming up, much more on the market gains and possible signs of froth. But as we head to break, let's look at one area not participating in this rally: restaurants. We highlighted this group last week Now another leg lower for names like Papa John's and Shake Shack. Bank of America downgrading those stocks, saying the divergent trends among restaurant segments will persist, and the largest competitors in each segment will be insulated. Overtime, we'll be right back. Welcome back to Overtime. Bitcoin today hitting a record high above $125,000, up 2% at the moment. That's its first record high in nearly 2 months, up 10% so far in October, coinciding with the government shutdown. And a lot of the crypto-related names are gaining, as you can see here. Galaxy Digital, Riot, Mara, and a couple of the smaller names, Bitfarms and Hive Digital. So, are the gains in crypto a sign of froth or just optimism in the market? Or maybe it's a little of both. Let's bring in senior market commentator Mike Santoli, who's taking a look at how risk appetite might be rising. Mike.
For sure, John. You know, for most of the time since the climactic market low in April, just about 6 months ago, you were able to argue, hey, look, professional investors have not really rebuilt their equity exposures. They remain kind of behind the market in terms of playing it to the fullest. Well, that might be less valid at this point. This is from Bank of America. It's information from their prime brokerage business, which serves hedge funds. It shows gross hedge fund exposure. That would be the blue line there. That means long positions plus short positions is pretty much at a new high, whereas net leverage, that would be longs minus shorts, is essentially matching what we saw around the election, the aftermath of the election last year. So also pretty fully invested and pretty aggressively so. It doesn't mean that this rings some kind of a bell, but it shows that it's sort of more the case now that the fast money and the professionals are more involved and therefore are not out there just waiting to pounce on every little wiggle lower. Now, you mentioned those crypto names and some of these other sub-themes within technology, the more speculative side where you don't really have a whole lot in the way of financials and fundamentals. So here's drone makers. That's a basket of just these companies that are involved in drones. Quantum computing, very, very much a distant what-if type technology people are betting on. And then crypto-related public companies, not crypto coins themselves. This is from Goldman Sachs. They have these custom baskets. And note, this is a year-to-date, and they've all at least doubled in a market that on the S&P basis is up about 14, 15% year-to-date. So people are definitely finding things to play. So some of the market looks like a video game. Some of it looks very sober and normal and orderly. So it's a funny mix.
But does it mean, Mike, as I look at that first chart, does it mean the market has a lot of weight on its risk leg? So if Cobra Kai, Karate Kid style, that leg gets swept, there's a bigger fall perhaps to come?
Yeah, I do think that there is some pent-up energy in that direction. So the market does feel like it's kind of tightly coiled. There's a lot of ways to measure this. You know, in past weeks, I showed how the correlation among stocks is really low. So everything is in this delicate balance of kind of keeping it together, but there's a lot of upside volatility in individual names, a lot of downside volatility in others. And so, yeah, I do think that you can make that argument that essentially nobody's really ready for some kind of an air pocket here. Now, the thing is, it doesn't mean that we are now at the maximum extreme of where that can get to. But I do think you want to be aware that it's no longer the case that we have this kind of cushion, this margin of safety, which is represented by under-invested pros out there.
Well, can't say we weren't warned. Mike Santoli, thank you. See you in a bit. Well, it's time for a CNBC News update with Kate Rogers. Kate.
Hi, John. The House Oversight Committee canceled the deposition with former FBI Director James Comey that was scheduled for tomorrow as part of the committee's probe into Jeffrey Epstein. Comey stated in a letter to the committee that he had no relevant, quote, knowledge or information about Epstein or Ghislaine Maxwell. The committee also canceled a deposition with former Attorney General Merrick Garland. A federal judge said today that she's likely to release Kilmar Abrego Garcia if the federal government can't provide its plans to deport him by Wednesday. The government said Abrego Garcia, who was mistakenly deported to El Salvador by the administration, would be sent to Eswatini, even though Abrego Garcia said he'd be interested in being deported to Costa Rica, which was promised him legal residency. And the National Weather Service confirmed today a tornado that tore through eastern North Dakota and killed 3 people in June was a rare EF5 tornado. Meteorologists said it was the nation's first EF5 in 12 years. It had wind speeds of 210 miles per hour and was more than a mile wide. John, back over to you.
Terrifying. Kate, thanks. Well, lots of record highs today. Gold, Bitcoin, the NASDAQ. Here's a look at some of the individual names hitting records. Newmont on the back of gold's rise. Northrop Grumman, one of the several defense names hitting highs. Caterpillar also hitting a high, and it began trading way back in 1929. Well, nearly 100 years of trading, and Cat has a similar market cap to AppLovin, even with a big drop late in today's session. AppLovin is still up 70% in 3 months, 167% in 6. Is this decline a chance to jump on a hot stock? Well, we'll be right back. Welcome back to Overtime. Markets closing mostly higher. The Dow losing just 63 points. The other two major averages and the Russell closing at record highs. AMD, the big stock story of the day, soaring almost 25% on its deal with OpenAI. Figma, Coursera, HubSpot, some names jumping because they got mentioned at today's OpenAI developer event. And the government shutdown dragging on, and we continue to see money pile into crypto and metals. Bitcoin hitting a record above 125,000, gold too, just shy of 4,000. We got results from Constellation Brands earlier this hour, beating on earnings and revenue, but saying its beer business sales fell 7% in the second quarter and expecting those sales to continue to decline next year. The stock now up a healthy 3.6% here at Overtime. And take a look at shares of AppLovin now, plunging after Bloomberg reported the company's being probed by the SEC over data collection practices. This comes as the stock closed out the third quarter as the biggest gainer in the S&P 500, doubling in value. It's also among the top gainers in the NASDAQ so far this year. I met AppLovin CEO Adam Foroughi 3.5 years ago, the 10-year anniversary of AppLovin's product launch. That stock was trading at around $50 a share at the time. He told me AppLovin was born from frustration.
We built some apps and we couldn't get distribution. We couldn't get people to discover them. And that led us to wondering why there wasn't in 2011 a marketing platform built for the app developer to help them go promote themselves to consumers and get discovery on their products. Let's say you've got a company that just built a word game, something super innovative they want to bring to the market. Well, they have to go get discovery on it. They come into our platform and want to market themselves. They might build a video advertisement to showcase that cool new user experience, and they put it live. And on the other side, we're integrated into, at this point, tens of thousands of mobile applications.
AppLovin has grown tremendously since then. The stock up roughly 13x to close at $587 a share today, giving it a market cap around $200 billion. That puts it on par with companies like Goldman Sachs and Caterpillar. So can its momentum pick back up? Joining me now is Bernie McTiernan from Needham. Bernie, AppLovin has also expanded far beyond apps now into the web, going broader, and into AI as well, kind of competing to be the Nielsen of digital and AI, arguably. Are its prospects in line with this valuation?
Well, it's a great question. I think that the big thing is that there's already expectations built into next year for e-commerce, or as you call it, the open web. We think consensus has about 1.6 billion. And so the last time there was a new shiny object or new platform in performance marketing, it was TikTok, right? And so TikTok went from 1 billion to 2 billion to 5 billion to 9 billion. So I think that's the kind of trajectory you have to believe AppLovin's going to do with e-commerce over the next couple of years here. And frankly, like the self-service just launched 5 days ago, launched October 1st on a referral basis. And then they're going to go more widely at some point next year.
In a way, you're betting that this becomes something like a Meta or a Google, right, for the web era. Nothing yet has entirely tied together the full digital ecosystem, one might argue.
Yeah, well, I think an important thing to remember, too, is just how big mobile games has gotten. And we think mobile gaming is going to be a beneficiary of AI. Games should be able to get better. That's going to drive more consumer wallet share, more consumer mind share. And then also this other thing with, basically launched the birth of Axon 2.0, but the ability to use neural nets, making advertising that much better. So to go back to the first question in terms of the valuation, I mean, mobile gaming stocks, whether you're talking about AppLovin, Roblox, Unity, I mean, these are some of the most expensive stocks in our coverage universe, but frankly, rightfully so, because they seem like they're going to be major beneficiaries. And we're at a time when we've never talked about terminal values with our clients more than we are now. And it seems like this is a secular winning part of the market.
I remember a couple years back when AppLovin wanted to tie up with Unity, which now seems comical since I think Unity's at around a $16 billion market cap compared to the $200 billion from AppLovin. But what's your view on the lesson for investors to learn from that on how this marketplace shifts under your feet?
Yeah, it can move really fast. And that's why even you see Unity has had a tremendous year, and they're still early days in launching Vector, which is their Axon 2 type product. It's about half of their marketing platform right now. We think at some point soon they're going to launch it on the other half. But that's the thing, is things can move quick. And so I think what happened, as you looked at the disparity between market caps between Unity and AppLovin, is that when AppLovin went to acquire Unity or made the offer, they went with IronSource instead. And so there was a integration period between Unity and IronSource, while App just focused on rolling out Axon 2.0, and really Unity missed a whole product cycle, which allowed AppLovin to just explode and now be about $15 billion of gross advertising spend, and that's about almost half of the mobile gaming market, we think, right now. But obviously they're going through this massive TAM expansion going into e-commerce as well.
Life comes at you fast. Bernie, thank you.
Thanks for having me.
Well, President Trump, speaking to reporters in the Oval Office right now, Emily Wilkins has some headlines for us. Emily.
Hey, John, two big things that have come out of the Oval Office so far. Number one, Trump saying that he is currently in negotiations with Democrats over those Affordable Care Act tax credits. Now, Trump did not provide a lot of details, and what he is saying is counter to what his own press secretary said just a few hours ago, and saying there are no negotiations. So this potentially seems to be a very new development. We don't have a lot of details at the time, but if this is something that Trump wants to get done, that does add a lot of momentum to Republicans who are part of bipartisan conversations to get these tax credits through, and really could change the dynamic and direction of the shutdown, providing for a possible off-ramp. Second big thing that came up was actually an announcement saying that the White House has now greenlit a road through Alaska, more than 200 miles, that will help with the development of copper as well as other minerals. This is the Ambler Access Road, and it's Trilogy Metals has a huge stake in the road. This is something that they've been a part of, have commented on in the past. This road was initially greenlit by the Trump administration in his first term and reversed by the Biden administration, and now it seems to be back on with Trump. We also know that the House of Representatives actually voted last month to approve the access for this road. Of course, there are some environmental concerns, but at this point, it seems like Trump is hitting the go button on it, and of course could have big impacts for metals and minerals. John?
Interesting update. We'll have to see what Schumer and Jeffries have to say about shutdown negotiations. Emily, thank you. Well, President Trump, meanwhile, blasting the home builders. Up next, we'll tell you why he's now going after that industry. And later, Fast Money's Tim Seymour gives us the trade on Delta, which is reporting earnings tomorrow, and whether those results can help turn around the underperforming airline industry. Overtime, we'll be right back. Welcome back to Overtime. Home builders getting hit today as mortgage rates creep higher. Meanwhile, President Trump is also attacking the industry. Diana Olick explains why.
Well, John, President Trump posted that the home builders, quote, have to start building homes. They're sitting on 2 million empty lots, a record. He said, I'm asking Fannie Mae and Freddie Mac to get big home builders going, and by doing, help restore the American dream. Now, FHFA Director Bill Pulte, who oversees Fannie and Freddie, posted that he would do just that. Pulte then told me he would start meeting with home builders today. Now, when I asked specifically what FHFA could do, he said, we have a lot of tools as the main buyer of mortgages. As for the rest, the 15 public builders do hold roughly 2.2 million lots right now, but it's not a record, according to Zelman Associates. This chart shows the amount of homes being built relative to demand, and it's currently still over 100%. That means builders are actually overbuilding. And this chart shows they're aggressively building speculative homes, that is, homes without a buyer. So that gets us to what could Fannie and Freddie really do? Well, they can't lower mortgage rates. So the next option would be to lower underwriting standards to approve more borrowers like they did back in 2006. But that, in part, was what caused the worst foreclosure crisis since the Great Depression. Now, most builders have said what they really want is for the government to pressure states into easing regulations, which makes home building faster and cheaper. John?
Diana, also on the supply side, do the builders have the workers and the lumber available at prices that buyers can afford?
Well, lumber prices are going up, as you know, because of tariffs, and they do have a worker shortage for some, but others say that they have enough workers. It's just that everything is too expensive right now, and that's making it harder to build affordable homes.
All right. Diana Olick, thank you. Well, a pair of high-profile international markets swinging in opposite directions today. Up next, Fast Money trader Tim Seymour on where he sees the biggest overseas opportunities right now. Plus, Mike Santoli will come back to look at what a nearly $11 billion regional bank deal could mean for bank valuations. That's coming up on Overtime.